All right. Well, welcome everybody to today's webinar. And we are so glad that you've been able to join us today. We are doing these in a series, one a month. And I'm Greg Patterson, and I'm joined with my teammates, J.A. Kennedy and Tara Gould. And we are with Atlantic Wealth Management here in Morehead City. As I mentioned, we're doing one of these a month. And our hope is that we bring valuable information to you, and that these virtual meetings are helpful as you decide and try to navigate the landscape in today's ever-changing environment. So as we've mentioned, these webinars, sometimes we may have a technical difficulty. If we do, just stand by, we'll jump back on with you. We're so excited to be able to get our fiber optic cable in probably in the next month. So that's going to alleviate some of that. But nonetheless, we bring this to you in real time, and we're looking forward to jumping into our topics today. If you do have questions or you've got some things on your mind you want to share with us, please feel free to call the office, or you can even email in at McKenzie@myatlanticwealth.com, and that's MACKENZIE at myatlanticwealth.com, and Mackenzie will route those questions to us, and we'll attempt to get your questions resolved, certainly if not today on the webinar, by a phone call or a follow-up to you. So we've got a lot to talk about today. Let's go ahead and jump in and get started with what we'll discuss. We want to go over current market returns and provide a real-time update on where we are both in the equity markets as well as the NASDAQ for the tech indexes. We're going to talk through the latest economic data and give you up-to-date info on where the U.S. economy is. We're going to look at the recession indicators dashboard, those 12 indicators that we follow on a regular basis. Those are updated every 30 days. We're also going to talk through the leading economic index, or the LEI indicators. I think that's a good indication looking out the front windshield of where the economy is going. And a new term to our lexicon is de-dollarization. So we'll talk a little bit about that and share any info that we have with you. And then a special highlight today, we're going to talk through some Social Security strategies and things that you should know that we feel like would be important and a value add on this call. So we'll give you those. And then lastly, we'll share our conclusions at this point in the cycle. And we'll wrap it up with some after action. So with that, I'm going to turn it over to Tara, who can give you a quick update on our market returns. Tara, take it away.
Absolutely. If you guys have been with us for a while, you know I love talking through and looking at these charts. And so the first one that we're looking at here is S&P 500. This is year to date, so it's going to be January 1st through today. The S&P 500 is 500 leading publicly traded companies based on market capitalization. We do quote this index commonly, and also we use it as a benchmark. We do believe it is one of the best gauges of the U.S. equities market. And so the first chart that we're looking at year to date, you can see that the market low occurred. That was on Thursday, January 5th, at around 3,800. The high, same as last month, occurred, hasn't changed. That was on February 2nd at 4,179. Just to note, we did start the year around 3,800, and now we're currently trading above 4,100. I was thinking possibly today we were going to see a year-to-date high, but we closed slightly under that. But we're looking at a year-to-date increase of close to 8%. And this next chart, still we're on the S&P 500, but we're taking a look at a one-year view. From this point, you can see that the one-year high was just slightly a year ago. This occurred on April 19th. The S&P 500 was trading at 4,462. In this same chart, we also took a look at the low that was on October 12th at just above 3,500. Like I mentioned before, we're currently trading above 4,100. So if we take a look at that October low to now, The S&P 500 is up about 13%. Next, we have the NASDAQ. The NASDAQ is just another staple index that we take a look at. This is 3,700 companies. This is heavily weighted in technology. More than half of the index is technology companies. NASDAQ, slightly different. We did have a low on January 5th, and that dropped down to 10,305. And then a high on February 2nd, you can see that peak there. That was at 12,200. Again, we're getting close to that high. As of January 1st, we did start the year, the NASDAQ at 10,386. And so that puts us at a year-to-date increase of over 16%. And then the last chart here is also NASDAQ, but again, we're taking a step back and looking at the 1 year. You can see these numbers are a little bit different than the S&P as far as the high and low. The 1 year high for the NASDAQ, that was on April 19th at 13,619. The low, which was December 28th, so this was just right at the end of the year, the low dipped down to 10,213. And so that puts us in line with the year-to-date numbers of the NASDAQ being up around 16%.
Great. Thanks for that update, Tara. As we've been doing these webinars, we have taken time to just kind of recap the latest economic news or data that we've seen since our last webinar. And so wanted to just kind of hit these bullet points quickly to give you some updates. And we've talked about before how as we go down the list of these items, we see that some of them are positive, some of them are negative. So we kind of got a mixed bag of economic news. But this first bullet point here on the inflation front, we did have two important updates come out last week on Wednesday and Thursday, and that's the Consumer Price Index and the Producer Price Index. Those are two of the major, CPI is a major measurement of inflation, rate of inflation. And we saw that come in the year-over-year number at 5%. That was a full percentage point less than the previous month. We had been at 6%, down to 5%, and that's coming off of last July. We were at over 9%, 9.1%. So we've slowly come down. That was kind of a pretty significant drop for 1 month, the year over year, to go from 6% down to 5%. And then on the Producer Price Index that came out Thursday, also saw a significant drop from 4.6% the previous month down to 2.7%. So we like to look at the Producer Price Index and look at that as kind of a leading indicator for consumer prices, assuming markets are efficient and producer price cost savings are passed on to consumers. Doesn't always happen overnight, but we think that's a good trend. And for that PPI to go down underneath 3% is a good reading. Next bullet point there on the employment front, we did have another positive jobs report for March that came out the beginning of April. So we created 236,000 new jobs, and the unemployment rate actually dropped down from 3.6% down to 3.5%. So we continue to, throughout the increasing rate environment and slowing economic growth, we continue to see a job market that remains pretty strong. And then on the housing market front, that definitely has been an area that's been impacted by the rate environment and increasing rates. And so from a new home sales standpoint, we're down year over year about 19% on new home sales. And then we're down about 22% on existing home sales year over year numbers. So that would be a negative there with the housing market. Also with retail sales, we did see the number come in for March. That was a decline in consumer spending from a retail sales standpoint. So we sit at about just under 3%, 2.9% on rate of increase in retail sales year over year. That had kind of been keeping pace with the CPI number, but we saw a little bit of a divergence in that. And so we'll talk a little more about the consumer in general a little bit later on. Industrial production, that has been a negative area for a lot of the year last year and to start this year, but we have seen now a trend of we beat expectations for this last reading, and we've been positive for the last couple of months. So that's been a positive. And then GDP is gross domestic product. That measures the dollar value of goods and services produced in the economy. And it's a way we look at economic growth. And the first quarter GDP number will come out the end of this month. But just looking at projections across different Fed models, they range from 2% to 2.5% in terms of annualized growth predicted for the first quarter. If we see a number come in that range, that would be positive for the first quarter, although most economists are predicting we're on the downward trend in terms of slowing growth. And then the Fed there, we've talked about the Fed a lot over the last year, 15 months or so, as we've seen interest rates being drastically increased starting really last March up until we saw another quarter point increase last month. And so as we go forward, there is this question that remains: can the Fed maneuver a path forward to both fully combat and tame inflation, to fully do their job on the inflation front, but also stave off recession? And it's just thinking about that difficult task and what they're trying to maneuver. It did make me think of Top Gun Maverick. I did watch the movie recently, and Greg told me he watched the movie for the first time over the weekend. But Tom Cruise has his flight crew there, and they're trying to maneuver through this ravine, very tight ravine that is crooked and goes back and forth. But they have to fly low enough to fly underneath the weaponry that if they're detected, they're going to be blasted out of the air. But they have to go fast enough to meet their time target, so the enemy jets that are scrambled out don't catch them before they finish their task. So the Fed has a difficult task going forward, and I thought that was just an interesting comparison to point out there.
Yeah, they're trying to thread the needle, aren't they?
That's right.
Much like Tom Cruise in the movie. All right, so let's talk a minute about the U.S. recession risk indicators. The team here, we follow this closely. It updates every month. And we also follow the leading economic indicators that's put out by the conference boards. So these two, both this one from ClearBridge, and that's the anatomy of a recession, as well as the conference board indicators. This one's 12, the conference board is 10. The LEI is updated on the 20th of this month. So this week, actually, those 10 indicators are updated. But as you remember from our last webinar, the February numbers, did not look good. The LEI was down 3.6% over the 6-month period between August of last year and February of this year. This set of indicators, this 12 indicators, has 2 green arrows which signal expansion, and that's both within the jobless claims and the truck shipments, and 1 yellow in job sentiment, and the rest are red X's. There has not been any change since last month in these, and you can see by comparison the August, July, and June deterioration that we saw last year. Again, we signaled this on these webinars and have kept this front and center for our clients really just to say this is the data that's backing up the consensus among economists that we will experience a recession. I'd like to highlight the jobless claims for a moment. So the applications for unemployment benefits are broadly seen as reflective of the number of layoffs here in the US and is a key indicator for what's to come. If somebody's laid off, obviously they don't have a full employment income. And when they apply for their jobless claims, it can show up in these reports. It is green, but the April 8th numbers for the week ending April 8th, I guess those came out last Thursday. They rose by 11,000 to 239,000 from the week before. And those are put out by the Labor Department on a regular basis. So that's the most we've seen since January of 22, when 251,000 people filed for unemployment benefits. So the 4-week moving average of claims, which evens out some of the week-to-week fluctuations, rose by 2,250 to 240,000. That's the most we've seen since November of 21. So we're watching this close. It's still green, but we would expect that to turn red if those numbers continue on, and is a good indicator of the consumer and the resiliency of the consumer. And if we put this in relationship to other periods of recessionary activity in the economy, we can see those. The most recent one was 2020. That's the onset of COVID, more like a shutdown in the economy than a recession, but nonetheless, it did show up as a recession. And you can see the number of green arrows that still signaled expansion. And then, of course, we've got the influx of money that came in from stimulus and so forth that contributed to the inflationary environment that we have. And then we are today under the current situation, which is pointing towards recession. So again, we're monitoring this closely. The data updates every 30 days, and then we bring that to you on these webinars. We think between the two, the LEI and this anatomy of a recession through ClearBridge, gives you guys the data that we're looking at as well.
All right, like Greg mentioned, we do have some new data coming out this week with regards to the LEI. But for this chart, what I wanted to look at, and just a little bit of background on LEI, it is 10 indicators that we're looking at, things like GDP, employment figures, CPI, those things that JA was just talking about before. But what this chart shows is for each year, we have going all the way back to 1960. What you're going to see in that lovely like greenish blue color is the number of months that the LEI has declined. And then in that gray background, you'll see the recession pop up. And so what we're looking at here is for the past 11 months, we have seen leading economic indicators decline, which supports the argument that a recession is on the horizon. We've been talking about a recession for a very long time. This has been coined as the most anticipated recession of all time, and I definitely can agree with that. But one thing I want to mention is recessions are a part of a healthy economic cycle. These are things that, while we don't necessarily pinpoint exactly when it's going to happen, that is part of the financial planning process because we know they are going to happen. And so when people or clients have fears about, something that's upcoming, we do like to go back to, the financial plan to revisit that and to talk through that these are the things that we have anticipated. And the next slide here. So the first chart that you're going to see is credit card rates. And so credit card rates have actually increased in the past couple of years. You did see a dip for a moment, and then they have increased. And so factors that come into play with this, mostly just interest rates increasing over time. But we just think about how that's going to impact consumer and consumer spending, which is such a large part of our economy and our economic growth. The second chart here is consumer credit. And so revolving credit, which is mostly going to be credit cards. You can see that there was a dip down again in 2020. This can be explained by just, the influx of money that came into consumers' wallets. Maybe some of the, the choices that they made were to decrease some of the credit that they currently had. But you can see that the trajectory, that dotted line here, that we're right back on track even after that decline. So thinking through this, and are consumers going to be able to maintain this? Is credit going to continue to increase? And that would lead us into the next slide here, which talks about the labor market. Right now, the labor market still remains strong and is going to have to take a big shift before we actually dip into recession, but potentially that can happen in a shorter period of time than most people think. Any comments, you guys?
Yeah, just one thought is in that jobless claims report, the Fed predicted that the unemployment rate will rise to 4.5% by year end, which is a sizable increase historically. And I think, that's another, that they put that together with the inflation, the forecast on the recession.
It does raise the question. Normally after rate hike cycles on the part of the Fed, they're followed by rate cut cycles, because ultimately the Fed rate hikes serve to slow down the economy. And then oftentimes and historically, that's led to periods of negative growth or recession. Then the Fed cuts rates to kind of get things started back on the right track or a positive track. If they're holding tight to that job unemployment rate target, then they may be more likely to hold rates higher, even if they stop raising rates. Right. So we're paying attention to that going forward. That could be one of those things that if there's continued strain and stress on small businesses from higher interest rates, it could lead to a layoff cycle later on in the year.
Mm-hmm. Agreed.
Which brings us to the headlines of the week. We looked at a couple of headlines last webinar, one from before the SVB bank news and one from after. The one before was talking about all of the room for the Fed to continue to increase rates. And then the one after was just a total opposite headline just a week later. So it does show you how things can change sometimes on a dime or very quickly, even overnight. But looking back over the last week, probably the biggest headline last week was the inflation number that increased less than expected. And again, as I had mentioned before, is only up. It's up. I say only, still up 5% from a year ago. The Fed has a target of about 2%, so we're ways away from that Fed target. But we have continued to see it come down, and so that was a positive headline. I did pull just that headline from over the weekend, which is kind of a newer headline. We'll see if this takes traction, but the headline here from CNBC says, Yellen says U.S. banks may tighten lending and negate the need for more Fed rate hikes. So again, we'll have to see how this plays out. Does the Fed continue to hike? Do they hold tight? Do they cut at some point? And when is that? All those things are really unknown at this point, and I think will be dependent on data that we see, going forward and the trend of that data.
Yeah, the equity markets, as Tara pointed out, were positive just from that inflationary data. that came out. So it's nice to see that.
That's right. This brings us to the new terminology that Greg mentioned in the intro. Maybe you've heard of this, maybe you haven't, but we came across it just recently, this term of de-dollarization. I can remember going back even 10 years ago, folks, having conversations and being fearful of, whether or not the dollar is going to remain as the world reserve currency. And I think I prefaced the whole conversation around just the fact that fear does tend to sell. Mm-hmm. And so for folks that are scrolling through social media or dependent, even just the regular traditional media these days, it's hard to find something that doesn't have kind of a fear hook to it. So that being said, I'm not minimizing the news that's come out recently. This picture here with President Xi and Putin, China and Russia, they did have a recent meeting, and there was an agreement coming out of that for Russia to accept Chinese yuan in energy purchases. I think there was a similar agreement maybe with Saudi Arabia as well, and China. And so it was specific to the energy sector and specific to these agreements. So I think it's a big jump to say that, there's this global transition from the dollar to some other world currency. And I think you also have to fill in the blank with, hey, what is that other currency that the whole world is going to put their trust and confidence in? There's been no other currency that's, and it continues today, as stable as the dollar. The yuan has been much more unstable. And, just look at the type of government that they have over in China as well, as compared to a free enterprise system. It's a communist system there. And so it'd be hard pressed to find another alternative to the dollar right now. That's not to say things can't look different way down the road, but right now I think there's some playing on, that fact that fear does sell. Mm-hmm. And there's been some recent headlines that can be played off of. So that's kind of where we stand right now in this de-dollarization. I'm sure we will continue to hear more and more about it, and we'll stay abreast of it and be giving you updates as we have them.
Yeah, I'm glad you brought this up, because the currency, if it was going to replace the US dollar, would have to be a better currency, right?
Yeah.
And I don't think there's any freer economic system than what's here in the US. So, it's more headline news, and I think it's attention grabbing. Those countries aren't really free. And I think that would have to be one of the key ingredients, don't you?
I agree.
Democracy.
I think there's also some hedging of risk. So with these countries, again, these are specific agreements around just mainly spending the energy sector. So some countries are bigger players than others in that sector. So that probably has something to do with it as well.
Mm-hmm. And so the question that we've been getting some in our review meetings and meeting with clients, talking to them over the phone, is, are we going to be okay? Probably more than not. We also hear the question of, or the statement rather, that, this time it's different. And those are famous words that we've heard before over, I guess, two decades of doing this. I think we wanted to focus on the "are we going to be okay" question, because it really is. It comes from a place of genuinely wanting to know, and wanting us. We're paid for our advice, of course, in our account, so wanting us to advise clients, and so it really causes us to lean back on the planning that we do for clients. And we think that most clients can pick a good CD or a good money market, maybe even a good stock or a mutual fund, but to bring all the disparate parts of their financial life together, it's complex. Let's face it. We're going to talk a little bit about Social Security, and you'll see how many decisions have to be made. So when it comes to asking the question, are we going to be okay? I think more than anything, clients want to know, hey, we're not going to have to worry about running out of money, are we? I don't want to have to go back to work if I'm retired, or if I'm planning for retirement, do my plans have to change? And so that's where the planning and advice that we provide comes to bear on this. And I think it's important, if you're concerned, if you're going to be okay, ask us, and we'll tell you, we'll show you the results of your plan and bring the dollars that you have invested back to why you invested those in the first place. But we can also take a longer term view of this, and we've got a slide that shows the market. And what you're seeing here is going back to September of 29. And you see the far left of your picture there, the big drop, that was the Great Depression. And then we've divided this up into 20-year time periods, with the exception of 1970 to 1980. And we believe the time that we're in right now on the far right is called a secular bull market. This is when the markets continue to go up over a longer period of time than they go down, which would be entitled a bear market. And that's the gray shading, the teal shading highlights markets that are going up. And this is just equity markets, okay? So it's not really respective of a fully balanced portfolio with the 4 asset classes. It's just looking at the stock market. And so on the right-hand side, this is 2010, the year 2010 to where we are now. We've had 346 all-time highs and a cumulative return of 268%. And we think we have a few more years to run in this before we see a downturn. It's interesting that it's reflective of the late 70s and early 80s with where interest rates and inflation are. Certainly interest rates aren't as high as they were back then, but inflation is the hot topic and something that we're focused on. And so again, we don't have a crystal ball. We think that you stay invested, and recessions are a normal part of the economic cycle, the business cycle. And we would tell clients, if you're invested 55 miles per hour, that's probably a 70% allocation to stocks, 65 to 70% allocation to stocks, and the rest among fixed income, that you should experience 2 negative years of returns and 8 positive in every decade. And that's a healthy expectation. We don't try to avoid the recessions because it's really difficult to tell you when those are going to be, but we do make adjustments. And we think that having that outlook or that view definitely yields more positive returns and results for our clients than trying to time the market. And so 70% of the time that has worked in your favor if you're a 100% equity investor. So if you take a little bit of that risk off the table, it's probably 75% of the time that you'll see those types of returns to your advantage. So I just wanted to highlight this for clients that look at their statements. Certainly for the first quarter of the year and even up to year to date, your results have been pretty good. But for last year, I know we're all looking at those annualized returns, and this can provide some a longer view, I guess you could say, and some healthy expectations around where we are and where we think we're going to go. Any comments on that, guys?
No, I was just going to say it does highlight that the bull market is on average runs about 20 years. So we're for 13 years in, still predicting a few more years of a bull market.
Yep.
We're going to shift gears a little bit. Each month, we've been selecting a financial planning topic to highlight whenever we do our webinars. And in honor of National Social Security Month, which is in April, wanted to talk through Social Security and the decisions around deciding when in order to take your benefits. This is a popular conversation that we have with our clients. And so whether you've already made this decision or you're thinking about it, wanted to just highlight a few things. So the first is, where can you see your estimated benefits? If you have not already, I encourage you to set up your account at socialsecurity.gov/my-account. I think it's important, even if you're not looking at retirement, in the next few years, even as you're starting. So, talking to your children, your grandchildren about this, we think it's important to look at your Social Security record and look at the earnings that are being reported each year. So I say at least on an annual basis, going in and taking a look at that account. And if you've done that, you're going to see that you receive a benefits estimate, and that will show if your income stays on that trajectory and you work up until those specified years. So it's going to show you at age 62, which would be the age in which you would pull early benefits. It's going to show you your full retirement age. For most of our clients, that's 66. Maybe 66, 6 months and into age 67. And then it'll show you those delayed benefits at age 70. And so that's where we typically ask you to start, is to go ahead and let's pull those statements and talk through that. There are some retirement estimators also at socialsecurity.gov and several different calculators that you can use as well. So the question is, how do I maximize benefits? And so several ways. The first is to improve your earnings record, which could be a couple different things. Increasing income. Now, Social Security wages, there is like a cutoff amount for that as far as what counts towards Social Security. So increasing that, and also working longer. So maybe you had some years in which, or potentially your spouse had some years in which there were no earnings. Filling in those zeros and just working for an extended period of time. Most of you know that delaying benefits can increase or maximize your benefits. So if you were thinking potentially, maybe I want to take at 65, waiting until 67 or 70. One of the things I do talk with clients about is there's not a one size fits all answer. Many times I'll hear people say, you must take at 62, you must wait until age 70. It really depends on your full overall comprehensive plan and how Social Security fits into your retirement income. The next bullet point here is taking advantage of spousal and survivor benefits. These get very complex. And like to talk individually with clients about that, but we don't want this to be left off the table if there are potential options to pull spousal or survivor benefits. Minimizing taxes on benefits. So thinking through how long are you going to work and what those wages are if you decide to draw Social Security benefits before your full retirement age. After full retirement age, the rules are different, but definitely want to concentrate if you decide to take those benefits early and what your wages are. And then, like I mentioned before, just coordinating Social Security benefits with your overall retirement plan and when's the most appropriate time in order to apply and begin receiving those. Divorced spouses, I wanted to bring this up just in case you were not aware, or maybe you know of someone who could take advantage of this. If you were married and now you're divorced, you do qualify for divorced spouse benefits if you meet these qualifications. And so the first one is that the marriage lasted for 10 years or more. The next one is that the divorced spouse benefit if you are unmarried. So the person that is applying for this has to be unmarried. The ex-spouse, so the person you'll be drawing the benefits off of, is at least age 62. And then one last caveat here is that divorce was at least 2 years prior. If that's the case, your ex-spouse does not have to have filed for benefits in order for you to file for a divorced spouse. And it's similar to the spousal benefits, which means that you would receive a portion of your divorced spouse Social Security benefit. Survivor benefits. This is, again, one of those that can get complex, but we want to know how we can coordinate. Is it a possibility that you go ahead and apply for survivor benefits and then draw on your own record, or vice versa? And the reason we think this through is for survivor benefits, you can actually apply for those at age 60. Some people call it a widow's benefit. But what if you, as the survivor, if your benefit is lower, drawing on your own record, and you wait or you delay until your deceased spouse, those, you can earn those delay credits if you just push that back a little bit. So it might make sense in order for you to coordinate, draw one first and then wait for the other. Do you guys have any comments about survivor benefits?
I think you touched on it all right.
Okay. So to make sure I didn't miss anything. And then the last thing here is we want to look at retirement accounts, your overall investment portfolio, and also if you're going to continue to work or have earnings before you draw those benefits. And that's why we call it a comprehensive financial plan. One of the things we like to run is all of the different scenarios and take a look at basically your lifetime earnings. If you were to draw at 62, 65, 67, or if you waited until full age 70 to take a look at that.
Great. Thank you, Tara.
Of course.
As we've been doing these webinars, we do always like to end with some biblical wisdom and truth. First of all, I hope that everyone, I guess weekend before last, did have time to celebrate and remember Christ's death and resurrection at Easter. So I hope everybody had a good holiday there and a meaningful one. But the scripture today is from 1 Thessalonians chapter 5, verse 11, and then 15 and 18. And Paul is writing to the church to just encourage and instruct them. And he says, therefore, encourage one another and build one another up, just as you're doing. See that no one repays anyone evil for evil, but always seek to do good to one another and to everyone. Rejoice always, pray without ceasing, give thanks in all circumstances, for this is the will of God in Christ Jesus for you. And so as we strive just to live out our faith here, we are seeking to be an encouragement and to share truth. And we're thanking God just for each one of you and the relationships that we share.
All right, that's another one for the books, as they say. And in fact, we'll be able to post this to our website once we get compliance approval. Generally, it's 7 to 10 business days, maybe two full weeks. But we post it up there just as a record, but also it makes it easy for you as our clients. If you have friends or family that you think may benefit from some of the wisdom here, you can direct them to that, and they can download and view the webinar as well. So just another way that we want to be top of mind and be a resource for you guys. If somebody you love or care about needs some advice or wisdom, they can get it there. They certainly can call us as well, and we're glad to speak with them. We do appreciate you for the referrals and introductions you've sent over the years. It means a lot. And we're very grateful for that. And really, it's the highlight of our day to sit in front of you and to know you and to provide advice around your situation. So it's a big week this week, obviously on the economic news front, but also on Friday, we've got our annual shred event. And so we're going to pack the parking lot next door. We're going to have a big shred truck and shred all your documents, many of which come from our office. So you'll be able to shred all that and enjoy some Chick-fil-A, either a biscuit in the morning, or if it gets closer to noon, a sandwich on us, and some good fellowship. It'll be 10 to 12 this Friday, so bring out what you can, come see us, and share it with your friends or family. It is a community event, and we're taking care of it, so look forward to seeing you, and hope you finish out April. If we don't see you this month, we'll look forward to seeing you at our next review, and have a great April, springtime.
Bye, guys.
Take care. God bless.